From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable, and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we go into a deep dive on our risk-on, risk-off portfolio and why we think it is a powerful alternative to the traditional 60-40 portfolio, a way of balancing your portfolio with stocks and bonds. We discuss this in detail, and if it's something you'd like a little bit more clarity on or a little bit more information on, feel free to give us a call, 270-600-PLAN, or navigate to our website, rdswealth.com, and we will be happy to help today. I hope you enjoyed this episode of the Retirement Matters Podcast. Good morning to you. I hope you're doing well and you're ready to start discussing all things retirement matters. This morning, we are coming to you with a very special show that you will not want to miss, especially if you are close to retirement and you have a portfolio that is built by a financial advisor. You need to understand some of the rules that financial advisor school, if you will, teaches us, and some of the things that we believe that you should probably change as you get closer to retirement. So we're going to go into all of that together, and you're going to enjoy the show. I'm confident of it. And the reason I'm so confident is because I am here joined by my trusty sidekick, one of my best buddies and an advisor here on the team as well, Mr. Quentin Nifley. How you doing, Quentin?
I'm doing good. Glad to be here.
Yeah, Quentin is going to be joining us here with this conversation around the traditional way of managing money in the stock market between stocks and bonds, and some things that perhaps are weaknesses for that traditional way of managing money in the current market we find ourselves in, especially as we get closer to retirement or living in retirement. We're going to discuss all of that, as I said. But Quentin, before we get into that, you know, this is the part of the show where we go into the pause for positivity. There's been a lot of actually good news as of late, depending on which station you watch, I suppose.
100%.
But right, yeah, I mean, Iran seems to be clearing up just a little bit. There's certainly some room for things to still get worse. That's not completely cleared up, at least at the moment that we're on air here. But what I do know is there are things that you can look for that would give you a positive perspective. And that's what we want to do every single weekend we come here. We want to bring you something that just gives you a little bit of a positive perspective on life, a little bit of a positive attitude, maybe even just an inward reflection of where we've been, what we can do to make someone's life a little bit better. And there was a story that one of my friends told me that reminds me of this. He was telling me a story about, I think he maybe even read it on the internet, about a grandmother who sat down with her grandson. And this grandmother was writing a note, and the grandson, a young boy, looked at the grandmother and said, "Grandma, are you writing about me?" She turned and looked at the young boy and said, "No, but I do have a lesson to teach you. Do you see this pencil?" She holds up the pencil. The young boy's eyes fix on the pencil, and she says, "You see this pencil? It's making marks on the paper. And just like this pencil, the things that you do in life will make a mark. They will make a mark for good or bad. It's up to you. Secondly, I want you to look at this eraser. And I want you to know that this eraser means, just like in life, when mistakes are made, they can be erased. And third, I want you to think about what's in this pencil, because the true value of this pencil is what lies inside. It's the lead. It's the lead inside of it that makes it valuable. Fourth, grandson, I want you to think about this pencil. It would not work if it were not sharpened. And unfortunately, life sharpens us. Sometimes it's painful, but it's necessary to make us into what we're supposed to be. And fifth, I want you to think about this pencil in my hand. And what it does is it reminds us in life that we should stay in the hand of the person or thing that is guiding us. And what that tells us, that's a very quick story. And when he told me that, I immediately knew I have to bring it to you on this show because that has some incredible insight. Now, can't tell you if that's a real story. Could be made up. But Quentin, some powerful, powerful stories there.
For sure.
Some powerful stories. Marks, what we do matter. Makes marks on people. Be good to people. Treat them the way that you want to be treated. The Master taught us that when he walked the earth. But if you make mistakes, they can be erased. And it's really what's inside of you that makes you who you are. Life's going to sharpen you, but it's a part of the process. And as long as you stay in the hand of the man who's guiding you, all will be okay. So no matter what season you're in, always remember, mistakes can be erased, challenges will sharpen you, and your life is still writing a beautiful story. This is an incredible, incredible story. I wanted to share it with you. I hope you've enjoyed it as much as I have. We're going to break right there, Quentin. We're coming back with a lot of content. That's our Pause for Positivity this week. A lot of things that you need to know about if you're starting to retire, getting close to retirement over the age of 59 and a half. It's important that you begin to restructure the way that you think about your investments. That's what we do here every single week on this show, and it's what we do every day at RDS Wealth. Before we take a break, I'm going to remind you one more time that we have what we call the Retirement Atlas Toolkit, which is the toolkit you need to build your retirement plan and build it with efficiency. It is on our Facebook page right now. If you go to RD Smothers Wealth Management on Facebook, you will see at the top, it's pinned as a post. It'll be a link for you to get to our free resource that we're providing for you. This is the Retirement Atlas Toolkit. You're going to want your copy of this because it has a ton of resources helping you navigate retirement. And clearly, if you need assistance in building your own retirement plan, our team is here to assist in that endeavor. All right, we're going to a quick break. Don't go anywhere. We're coming back with more Retirement Matters right after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of RD Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. I'm here with Quentin, and another advisor here on the team is going to be with us throughout this conversation because it's important to understand that when you are working with a retirement advisor, when you're in retirement income phase, there's so many questions, so many decisions that have to be made. We believe wholeheartedly that you should have a team around you. This should be a team approach. And no matter who you talk to on our team, every week we are revisiting plans for clients as a team with many sets of eyes on those plans, making sure that we're making the right decision, not based off of emotion, but rather math and science. And Quentin, one of the things that we've really been seeing lately, especially I'd say over the last 3 years at least, and probably even going back all the way to 2022, which strangely enough was 4 years ago. But in 2022 and on, we've seen an extreme amount of correlation. That's a fancy word for essentially things move the same way between stocks and bonds. So what used to be considered a traditional balanced portfolio, something that would remain pretty consistent in good times or bad times, was something that is deemed the 60-40 portfolio. This 60% of stock, 40% of bonds. Now, I'm going to let you explain some of that, but for the listening audience, basically, I want you to hear when you have a traditional balanced portfolio, which is how we've been taught as investment advisors. I've been doing this for 17 years, and when I started, that's it. A balanced portfolio, 60% stock, 40% bond. That would give you the what we would call safety. I'm using air quotes here. Safety inside of that portfolio. If the good times come, stocks do well. If the bad times come, bonds do well. Man, that's just not the case any longer.
No, it's not, Dale. And I would even challenge that this goes back even farther than 4 years.
Sure.
The past decade has shown us time after time that bonds and stocks have a direct correlation to one another.
Yeah, which is exactly what you don't want in retirement.
Of course.
Yeah. You don't want both your safe money and your risky money moving the same way when times go good or bad, really.
Yeah. And if that's the case, you would just stick everything into a stock position.
Sure.
Because of the capital appreciation that you see on those. If they're going to drop the same, well, you would like them to grow the same as well.
Right. Yeah, you're right. And so I like what you're saying. Over the last decade, essentially, this correlation between stocks and bonds, and again, correlation means how they move, is more direct. So when stocks, traditionally, it was when stocks do bad, bonds do well. When bonds do poorly, stocks do well.
Oh, yeah.
But at the end of the day, now what we've seen is stocks doing poorly and bonds also doing poorly.
Yeah.
And we don't have to go back very far.
And all you're doing is handcuffing yourself to those lower gains that are most generally tied to an actual bond.
Yeah, and with yields where they are, you've got to think that yields are going to fall. And when yields fall, those bond prices lose value. So I don't see that breaking anytime soon. I think that direct correlation between stocks and bonds is likely here to stay for some time. Yeah. And for that reason, it's important that we look at a different way of managing money, because the idea of a income-based portfolio has to have some stability. So this is where we have crafted a very unique way of managing money inside of RDS Wealth by utilizing structured notes and options and different types of products that give us protection. Let's talk a little bit about this risk-on, risk-off approach to retirement planning.
The risk-on, risk-off really takes all the guesswork out of how much stability do we need into a portfolio. With the way we structure them, in the good years, we're taking income from our risk-on. Bad years, it's okay. We've got our income stable in our risk-off.
Yeah.
And the beauty is the risk-on that would be our stocks, our 60% stocks, perform well in the good years.
Yeah.
Well, our 40% risk off, which is the bond alternative, it also performs well.
Sure.
So we get the best of both worlds. We're not tied down to, well, the stocks are doing well this year, so the bonds are not.
Yeah.
Or the bonds are doing well, so the stocks are going to drop.
Sure.
So it really takes a lot of the guesswork out. It gives you the best of all worlds. If the markets perform, you're going to perform very smoothly and very efficiently.
Sure.
If the markets, we see a huge decrease, you're not going to feel that hardly at all.
Nearly as much, yeah. You know, and it would depend on the dip, how sizable of a dip it is. But you're right. That risk-on, risk-off portfolio weathers a lot of these, especially these small pullbacks that we've seen, just like the last few days that we've seen. 7 to 9% dips in the market are normal, and actually a 10% dip every year is normal. You shouldn't be panicking when you see that. But if we're able to build a risk-on, risk-off portfolio for a retiree, it allows us, or a pre-retiree, it allows us the stability during those downtimes to continue to generate the income that they need. And you're not spending or selling securities or stocks at a loss.
Yeah. And it's even good if you're not taking income.
Sure.
I mean, that risk-off portfolio, that risk-off portion, it gives you a opportunity that you are not fortunate to have when you have bonds that fall also.
Yeah. Man,
when our risk off is down 0 and everyone else is down 20, and that risk off is down 0, we're buying things on sale like no other.
Yeah, and you know, that's a bold statement here on the radio too, to say market's down 20, we're down 0. And so for my compliance listeners out there, I want to be very clear. We do have things that we can put into that risk-off portfolio that give us ultimate downside protection.
Yeah.
The market itself cannot take the gains that we've made, nor the amount of money that you put to work there. And so we can stand boldly behind that and know that that is a tool that we use Does all of your money belong there? Probably not. Probably not. And, if you got somebody that's going to come in and sell you just, here's a magic bullet that will never lose you money, but it'll always make you money, it's a very good chance that it's not going to make you much.
No.
But this tool that we use, the way that we structure these between structured notes and options, or even if we're looking at a good, strong growth annuity or an insurance-backed CD or any of these things, give us downside protection along the way, and then that type of stability in a portfolio allows us to harvest your income with predictability, even in market downturns. So that's a real quick snippet of the risk-on, risk-off portfolio. I really want to explain a couple more things about how a retiree should be considering their portfolio compared to a risk-on, risk-off portfolio, but we're going to take a quick break before we do that. And so, again, there's our pitch on how we believe you should be building a retirement portfolio, because we know we work in the retirement income phase position. We're there all the time. That's where we concentrate every bit of our emphasis on. And so we want to lessen volatility. We talk all the time about losses hurt us more than gains help us. Gains are going to come. Markets well, you're well. Markets poor, you're not hurt nearly as bad. That's because of this risk-on, risk-off portfolio. Now, I'm going to take a quick break. I'm going to point you back to the Facebook page one more time. I'm going to tell you that if you are interested in this type of strategy, go to our Facebook page, RD Smothers Wealth Management. We are offering a free resource for a limited amount of time. This is the Retirement Atlas Toolkit that will allow you to kind of take a peek under the hood to see if this type of retirement planning is right for you. And if you need assistance with that, clearly we would be glad to help you. If you're wanting to do it on your own, though, there are some resources in there that you cannot do it without. You've got to make sure that you take a look at those. And, of course, you can always reach out to our team, 270-600-PLAN. If you need any assistance, 270-600-PLAN will get you in touch with one of our team members. And, again, very simple for you, rdswealth.com. If you want to set up a time for us to reach out to you, that's convenient. Quentin, hang tight with me for about a 30-second break here. We're going to take a reset, and we're coming back with more Retirement Matters right after this.
Thank you for listening to Retirement Matters, presented by RD Smothers Wealth Management. If you'd like to speak with us, give us a call at 270-600-PLAN. And if you enjoy the information in this show and would like to hear more, you can access previous shows by searching for the Retirement Matters podcast on the podcast platform of your choice. We also produce a weekly newsletter. Receive it free to your email inbox by signing up online at rdswealth.com.
All right, welcome back to the show. Let's jump into this phenomenon that takes place about when you said that rates go up, bond prices go down, and if rates go down, bond prices go up. Can you explain that to the listener in just a real quick layman's terms here?
Of course. A real quick scenario is this. You own a bond that is paying 3% per year.
Okay.
All right, now all of a sudden rates increase, and that same company wants to issue more bonds or basically sell more debt.
Yeah, borrow more money.
There you go. And so you now can have access to bonds that are paying 5%. Yeah. And so if you're wanting to sell your bond at 3% worth of gain each year, you're going to have to give someone else a discount, because why would you buy my bond at 3% when you can go directly to that company now and get 5% worth of yield each year?
Yeah. So if the investor is wanting to sell that bond or not, on their statement, it's going to show what it would be worth if they took it to the open market.
Of course.
And so you're going to see the price of that bond fall, because anyone willing to buy a bond at that point in time can buy them from the issuing company at 5% instead of buying them from, let's say, Quentin at 3%. And, if Quentin was the original holder of that bond, well, now he's got to sell that at a discount if he wants to get out of it, or his statement is going to show a lower value. And so then let me actually argue the opposite of that if bonds if yields were to fall, the bond itself becomes more valuable. And so you may think, well, Dale, we're talking about rates falling here in the next little bit. Why wouldn't a bond fund be okay at this point? And I'm going to tell you, for the short term, it may be the case that bond funds are okay, but retirement is not a short-term thing. It's a long-term.
20 to 30-year game.
It's a long game. That's exactly right. So if you've got a bond fund manager that's not holding these bonds to maturity, which they never do, and they sell your 5% bond and then go buy the 3% bond, well, now you have just locked in a lower yield for the length of time. And if interest rates go back up, because they do, you're going to be in trouble just like we were in 2022. Yes. So in this period of interest rate volatility, where interest rates are all over the place, we go to a war with Iran and interest rates rise, bond funds fall. This is exactly why the month of March was terrible for the traditional 60-40 portfolio, down almost 6% in a month. You can't build a retirement plan off of that 60-40 portfolio.
Not with confidence.
Not with confidence. You're exactly right. Man, that is so true. And so this is why we get so passionate about this risk-on, risk-off approach, and why it's important for us to understand that building a plan with confidence requires a different approach. Now, for growth-minded individuals, I'm going to tell you, there's not a lot that can, quote-unquote, go wrong inside of the stock market as long as you don't jump out of the stock market because it's down. I mean, clearly, the stock market's going to be volatile. It's the price of admission, Quentin.
Yeah.
But if you're growth-minded and you don't have many bonds anyway, I mean, if you're 30 years old,
shouldn't have any hardly.
bonds are probably not in your portfolio. So if you're 30, 40 years old, maybe you don't have the bond exposure and you're doing the right thing. But when you get over the age of 59 and a half, man, it's time to really start focusing on that income phase. And that income phase requires stability, which is exactly why we've built this risk-on, risk-off approach. And the stability it brings is something that brings you a peace of mind. If you would like more information on that, give our team a call, 270-600-PLAN. One of our advisors, maybe Quentin, would be able to sit down with you and explain to you how you can better your overall retirement simply by understanding market volatility, understanding that losses hurt you more than gains help you, and then mapping out a true income plan to give you the confidence to spend the money you desire. We don't stop there, Quentin. We go into taxes, we go into healthcare, we go into when to take Social Security. All of that is done at our firm because we're more than just growth advisors.
We are not just an investment firm.
You're exactly right. I mean, this is what we do every day to make sure that money's doing what you need it to do to be able to essentially retire and live happy.
Oh, yeah. If you're entering in the income phase of retirement and you just have an investment advisor that only deals with your investments and you haven't seen plans for the other four worlds, you're missing out.
You're so true. And I can't say that enough. You said it as good as I could ever say it.
The clarity that you get working with a true income advisor.
Sure. And it doesn't have to be R.D. Smothers Wealth Management. I'll tell you this, it has to be done the way that we do it. I do agree with that. But if it's our firm or a different firm that's truly sitting down with you and building a plan for income, a plan for when you need Social Security, when it's optimal for you to take Social Security, when it's optimal for you to do Roth conversions, when's it optimal for you to take Medicare, and you may think, well, it's 65. Of course, not always.
No.
Not always. And you don't have to take it at 65. There's a lot of myths that we can debunk. And this type of planning gives you so much clarity. It just works me up. If you can't tell, I'm already hyper here. This morning, I also want to remind you again of going to our Facebook. We've pinned a post, R.D. Smothers Wealth Management. If you will go to our Facebook page, you'll see a place there where you can download your very own resource, the Retirement Atlas Toolkit, which is going to help you start to build those plans that Quentin's talking about, those 5 worlds of
marketing. Even said last week that a lot of people have taken advantage of that toolkit.
Exactly. Our marketing departments put that together, and very happy that people are taking advantage of it. If you haven't grabbed yours, go there and get it now. We're going to take a quick break. We're coming back with a very short section here as we wrap up the show. Again, joined here by Quentin, an advisor on the team, and someone you would have an opportunity to talk to specifically if you gave our office a call, 270-600-PLAN or rdswealth.com. Schedule a time to talk today. Don't go anywhere. We're coming back with more Retirement Matters right after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. This is going to be a good section. I am really excited to just do a little bit of a deeper dive into how we structure this bond alternative. We've talked about it, the 60-40 portfolio, which is very likely, if you've been working with a growth advisor or just a traditional financial advisor, maybe you use mutual funds, whatever it is, you are likely in some sort of a 60-40 portfolio, because I'm going to tell you, that's just the way that the industry has taught advisors to do it, and it's worked up until it didn't, and we're here to tell you it hasn't, probably for the last decade. It's just not given the type of volatility control, or the stability is a good word, Quentin, you've used, that you just don't get that from a traditional 60-40. So with that in mind, Quentin, let's talk a little bit about this 60-40. We're not tearing it down altogether. We're not saying 60-40 is dead altogether. The concept still holds true. You need 60% of your portfolio. Most people, let me be very clear here, this is not a blanket recommendation. This is just saying that most people find it okay to have 50 to 60% of their portfolio setting in some sort of equity position. Equity meaning you own a piece of a company.
Yeah.
You just mentioned stocks, right? Stocks. The other piece of your portfolio needs to have some stability, some fixed income. And we believe that a strong fixed income alternative can be had and acquired without going to the bond market. And there are a lot of ways, Quentin, that we can do that. But, if you think about some of the most basic ways, for the sake of radio, we got about 2 or 3 minutes here. Let's just talk about how we would structure a piece of the risk-off portfolio.
Yeah, so we would then go to the market. We would purchase options based around the S&P 500. S&P 500 is 500 of the largest corporations and companies in America. These options would give us ultimate downside protection, which means if the market's down 20, you're going to be down 0.
Yeah.
If the market's up 20, unfortunately, with that protection we bought, we limited our upside potential. Currently, April the 18th, 2026, our upside potential is capped at around 10%, which is still amazing. And you couple this with our risk on portion, which we can still buy protection even in our risk on portion.
Yeah.
For instance, if we have a 50% risk on and a 50% risk off and the market's down 20, we would target our clients to be down only around that 2 to 3%.
Yeah.
Which is a huge buying opportunity. And even if it's not a buying opportunity, it's stability.
Stability, exactly. And we can generate the income that client needs from a position that behaves like cash in a down market. That is the way that we structure that risk-off piece, and the reason we structure it in the way that we do, with ultimate downside, even if it means giving up a little bit of the upside on that risk-off piece.
The upside is still amazing.
It's incredible, and it accomplishes objectives.
If the market's up 20 with a 50-50 mix,
sure,
our target would be up around that 12%.
Yeah, 12 to 15% should be achievable in that type of portfolio, depending on what parts of the market are going up and how we've structured this portfolio. And when you look at that compared to the normal 60-40 mix, a lot of times, we're talking about the S&P 500 in the sense of percentages. What upside percentage do you get? Well, most of the time, clients are only getting about 70 to 80% of what the market gives them on the upside. And they're taking 60 to 70% of the downside. Yeah, and sometimes all of the downside in the 60-40. And you don't have to look far back. Like I said, the month of March in 2026 was nasty to the traditional balanced portfolio. This is why we believe wholeheartedly that the 60-40 portfolio is needing serious attention from those who are close to retirement. If that is you, give our team a call, 270-600-PLAN. We can help you build the retirement portfolio that supports your overall retirement vision and your retirement plan. You need this type of planning to retire successfully, and we would be happy to help. 270-600-PLAN or navigate to our website, rdswealth.com, and we'll be happy to help you today. Until we talk again, whether it's right here on this same station or it's in person or over the phone, always remember, save money, plan well, and live happy in retirement. God bless.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. R.D. Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by R.D. Smothers Wealth Management.